Good afternoon, everyone. Um, my computer says it's 12 o'clock, so here we are. And welcome everyone to the 24 hours global webinar from GCGC and ECGI on the topic of the COVID-19 crisis and its aftermath, corporate governance implications and policy challenges. I'm Professor Lulu Lan from the National University of Singapore. For those who have joined us since this morning, thank you very much for staying on with us. And for those who are just joining us for the first time, we will begin the third session that's hosted by the National University of Singapore, as well as Peking University in a short while. So what we have arranged is that the first hour will be conducted by the National University of Singapore. And at 1 o'clock our time, we will hand the mic over to PKU. So I'll begin by saying that although we are very used to webinars now, but as you know, this is the first time we are running a 24-hour marathon webinar. There may be some technical issues that we may have to beg you to bear with us. So because people come in and out, the first 4 hours have been going on very well, and we hope that our 2-hour session will go well too. So just a few housekeeping issues. You're not required to stay for the next 24 hours. You can leave the webinar anytime and log on again using the same link anytime as well. If you are taking part as an attendee, and you have a question, please use the Q&A function on the bottom of the screen. We will try to get back to you after all the panelists have actually presented their papers. As you can see, we are trying to squeeze as many papers this hour. So we may not be able to answer all your questions, but we promise we'll take them back and maybe get back to you after the whole session. The whole ECGI proceeding will be recorded, and so you can access it when it's being published. Yes. So for the speakers, please remember to mute your mics until it's your time to speak. So without further ado, I will now invite my first speaker, Professor Dan Puchniak, to tell us on his paper on COVID-19 and the start of the history of Asian corporation law. Dan, please.
Thank you so much, Lulu. And I just want to start by really thanking ECGI, especially Elaine, Lulu, and NUS for making this possible. It's quite amazing to think that we've only been dealing with COVID-19 for a few months. To me, it seems almost like an eternity. But I wanted to start this talk a little bit different, thinking about the good times. And when you think about Asia, it's very interesting and very easy to think about the good times in terms of economic development. Indeed, if you look back and you go to the post-World War II period, and this is in fact old news, Asia has had an economic miracle after an economic miracle. And as a result of all of these economic miracles, millions, hundreds of millions of people have been lifted out of poverty. Asia has become the engine for economic growth in the world. And what is very interesting and where I want to start today is just focusing on the fact that in all of these economic miracles, what has been at the core of them has been state-owned enterprises, family-controlled firms, and corporate groups with cross-shareholding and pyramid shareholding at their core. This is quite extraordinary. It may seem like something that is very well known now, but if we go back to the dawn of this millennium, a mere 20 years, this was not what was predicted by many leaders in the field of comparative corporate governance at all. In fact, 20 years ago, the prediction was that the widely dispersed Berlin-Means Corporation, which was a creation of the United States and the United Kingdom, would be what we would see in the most advanced and developed economies around the world. Indeed, the famous article from that time, coming from Hansman and Crackman, was labeled "The End of History for Corporate Law." It was a very reasonable thing to say at that time, and it's always easy to look in hindsight at things. But clearly, we have not seen the end of history, and clearly within Asia, we have had this economic miracle without the widely dispersed corporation going throughout Asia. Now, saying that, that should not be confused with the fact that Anglo-American corporate law has proliferated within Asia. This, on one level, maybe people will say this is not that surprising. One reason why people could say this isn't that surprising is you could say, well, this clearly follows a path-dependent analysis. And that would be true to a certain extent, at least for Commonwealth, common law Asia, Singapore, Hong Kong, India. If you look at those countries, you can see Malaysia, that you could maybe have some common law explanation for this. And maybe path dependence helps explain this continual transplant of corporate law, corporate governance mechanisms from the Commonwealth to these Asian countries. But it certainly doesn't help explain what has been going on in Taiwan, Korea, Japan, and China, as well as Indonesia, Thailand, and other non-Commonwealth jurisdictions. A better explanation for why this has occurred at such an extraordinary level is probably the position that the UK has established for itself as a corporate governance leader and a corporate governance exporter, but more importantly, the role that the United States has played as the world's dominant superpower. And not just a dominant superpower, but a superpower which has put a lot of resources, effort, time into promoting international organizations, into funding international organizations like the IMF, the World Bank, playing a role in the OECD. And so in this way, it does make sense that the United States has, in fact, played this role of exporting its law to Asia. And that may be one good reason why Korea, Japan, Taiwan, China, Indonesia have adopted these Anglo-American corporate governance mechanisms. But on another level, it's quite confusing, right? Although there may be sort of good overarching reasons for this development, on a practical level, when you look at the context of Asia, this constant stream of importing corporate law and corporate governance mechanisms from Anglo-America simply does not make sense. Why is that the case? Well, the reason it's the case is because the mechanisms that have been created, the laws that have been written, have been framed and designed around the idea of a dispersed shareholding system. So if you look at something like independent directors, just to take one example, the original incarnation of the independent director was clearly something to overcome the problem of dispersed shareholdings and to allow the board to have a way of monitoring management. A more recent example is the law surrounding institutional investors. And especially if we look at the UK, is a very much an approach of institutional investors rising to the level where collectively they can control the shareholder float in an otherwise dispersely held market. So you have this disconnect between the logic of how the context works in Asia, which is based again on state-owned enterprises, family firms, and other shareholding structures that aren't dispersely held. And you have this disconnect that has arisen between the corporate governance context and the rules on a formal level and the mechanisms on a formal level that sort of lie above this context. And Professor Gen Goto at Tokyo University, Alan Ko at NTU, we've recently put out a paper where we call this faux convergence. Why faux convergence? Because it appears like you have Anglo-American corporate governance that has completely penetrated all parts of Asia. But in fact, when you drill down, it functions very differently. Now, what I want to say in the few minutes I have left, which is new and relates to COVID-19, is there's this trend that's been going on that I think has not been properly, or at least received enough recognition. Over the past several years, what has started to happen is that you've started to have the emergence in Asia of countries adopting these principles like the independent director in name, but in practice, they do entirely different things. Again, I will go back to the independent director as a good example of this. Every single Asian jurisdiction that has adopted the independent director has changed its function from something that is used to monitor management to something which is used to monitor controlling shareholders. And if we go to specific jurisdictions in Asia, to take Singapore as an example, the independent director is used in family firms to mediate between family members, something completely different than it was originally designed for. And if you look at stewardship, the recent proliferation of stewardship codes throughout Asia, you see exactly the same thing, where the label has been used, but on a practical level, Asian jurisdictions have been stretching the concept, and I would go further than say stretching it, completely changing it to do different things. The example I want to end with is Singapore's stewardship principles for family businesses. This is a code of corporate governance which has developed in Singapore, which has absolutely nothing to do with institutional investors. And that is shocking, because if you say stewardship around the world, the one thing that people will likely agree on is that it has something to do with institutional investors. Rather, the Singapore stewardship principles for family businesses is completely designed for family controlling shareholders. And the most important point for what I have to say today is it's designed to set a new framework for Asia. And here is the question I have. With Asia now starting to stretch these Anglo-American principles so far that they've become so localized and truly Asian in their essence, at least in their function, but perhaps not in the label that is used. What is going to happen when we move into this era where I think we're going to see more regionalism over globalism? What is going to happen when the United States, which is already seeming to play much less of a role in international organizations, takes far less of an interest in corporate governance? And what are we going to see if Asia's growth continues, which I think it will? And what I think we'll see is much more of an Asian-centric corporate governance starting from Asia for Asia, like the principles for family-owned firms in Singapore. What does that mean for research? I think it means for research that a lot of the tools and mechanisms that have been developed in Anglo-America, which in the past have been used for cross-jurisdictional examinations around the world, may have less relevance in Asia. And this is really a call to action within Asia to say that there's going to be a lot more, I think, internal focused, uniquely Asian mechanisms that will develop. And I end with that and just say thank you very much, and to stay safe and to stay healthy. Thank you.
Our next speaker is Johan Sulaeman from National University of Singapore.
I hope everybody can see the screen properly. I'm not sure if that's the case. So can
Yes.
yes, okay, all right, excellent. Okay, so I'm glad to participate in this session. I would like to thank Elaine, the ECGI, and Lulu for organizing this part of the session, this part of the 24-hour marathon webinar. I would like to talk a little bit more about entrepreneurial activities, which seem to be a very important subject at the moment, given that we need a lot of high-tech solutions to tackle this crisis as well as the aftermath of this COVID-19 crisis. So this type of entrepreneurial activities can be related to the research for vaccines, drugs, antibodies, or all kinds of medical solutions to the problem, public health solutions to the problem, as well as for the productivity tools that we still need in this post-COVID-19 world. So things like the communication tools that we are using right now, for example, the Zoom platform that we are using now, Discord, or other online platforms that allow us to continue to be productive despite the fact that we have to work from home. As well as tracing tools to help solve the public health issues. Now, what I would like to discuss today is basically the idea that these entrepreneurial activities are fraught with a lot of information frictions. So these are frictions that come from the fact that, for example, founders and early investors may not be on the same page regarding what type of technology will be useful and how the technology can be very useful for the consumers. So this can be conflicts between founders and, for example, potential VC investors. It can also be between founders and the incubators that they are working with, or even with later investors, so asset managers, pension funds, once the firm becomes public. Now, I think this information friction is complicating the availability of funding from the perspective of the entrepreneurs, right? Because particularly for entrepreneurs that rely on heavily on technology, this technology can be difficult to understand, even from the perspective of investors. These entrepreneurs typically have very low or even negative earnings at the beginning of the life of the company, very high burn rate, right? So there's a lot of cash flow that is required to support the technology, to support the entrepreneurial activity, especially at the very beginning. Now, basically, the point here is that it's very difficult to issue equity, which is necessary for immediate funding as well as eventual exit of the entrepreneurs. And I put exit in quotes here. Now, what I would like to talk about is the fact that for what we have done recently in terms of research, we have been looking at informed local agents and looking at how they can facilitate this funding for entrepreneurial activities. Now, when we think about informed local agents, typically we think about VCs. Now, what I would like to talk about today is basically the idea that all kinds of information advantage that is available for local agents. So, for example,
Hey, I reboot. I don't know why all of a sudden I'm supposed to be in and I cannot. Can I reboot? How to force reboot and quickly force come in again? Quick.
Okay, so let me continue. We will focus on the informed local agents where we have lower cost of local information production, can access our information through conversations, for example, with firm managers and so on. These local agents are not just the venture capitals or even angels investors, but also local asset managers. So this local information advantage may become more important after COVID-19. During the crisis and after the crisis. So what I will do is I will talk very briefly about recent research that we did looking at the local asset managers and how this can affect the decision outcomes of local firms, as well as formation of new local firms, which is the entrepreneurial activity. Okay, so what we looked at is basically firms or new firms that are operating in information intensive sectors. So things like computing or pharmaceuticals, things that are very relevant for the post-COVID-19 world. These firms typically experience difficulty in finding financing, but what we find in the paper, in the research, is that these firms actually have experienced more efficient equity financing if they're located in areas with larger asset management industry. So this is beyond just the availability of VC funding. So what we find out is that when entrepreneurs and early investors operate in these industries, they tend to be able to cash out faster through IPO, but they get to keep more of the firm. So even though they're exiting the firm, they still get to keep more of the firm, and then they are able to invest more in R&D due to the ability to raise financing through IPO. Okay, this has a knock-on effect. The knock-on effect is that we observe that local entrepreneurial activities also become more active and more intense when they are operating in these areas with larger asset management industry. So what we find is that there are more new local firm formations in the high-tech sector. This again, in my mind, is likely to be more essential in the post-pandemic world, where you see a lot more isolation, mistrust, lack of coordination across countries, across states, across governments. And these issues can only be overcome with technological advances, and therefore the entrepreneurial activities will be a crucial ingredient for us to be successful. Okay, so just very quick takeaway, the asset management industry should play an indirect role in incentivizing entrepreneurial activities. This can generate a knock-on effect that firms become more active in the high-tech sector, particularly for computing, pharmaceutical, biomedical industries that are very important for this post-pandemic world. So I hope everybody stays safe. Thank you again for listening, and thank you for the ECGI and Lulu for hosting this. Now I noticed that Lulu is not online at the moment.
I just came back.
Okay,
So
so
sorry.
I will pass to
Yeah, okay, go
Lulu
first.
to continue with this 24-hour webinar. Thank you.
All right. Thank you so much. Thanks, Johan. I don't know. These things happen. You know. Let's go on to my slide. What I'm going to talk about is actually the role of the board in crisis time. This is based on a paper that we have recently completed with a few colleagues from different schools, and it's actually timely, and we thought we would just share it of some of the findings with the participants. So of course, we have seen what COVID-19 has brought to us. It actually brought unprecedented challenges to corporations and the boards. Liquidity is tough now. You can't perform contracts. We have talked about MAP clauses, frustration and force majeure clauses in contract. And we also have a lot of breakdowns from all these disruptions. So our question is actually, what is the role of the board during the times of crisis and disruptions? And are there any particular board attributes that's more important and better suited to deal with crisis? And is there something that we can learn from this crisis? So as I've mentioned, we did a paper which is just published on ECGI working paper series. It's on the advisory and monitoring role of the board. And these are some of the evidence that we get from disruptive events, not the COVID-19, but many disruptive events before COVID-19. And this is a paper which we did together with Ittori from University of Milan, Gerard Hertig from ETH Zurich, Leila Koja from Singapore ETH Center. So what we did was that we, of course, cleaned up and took data from 375 disruptive events, both natural or man-made. Natural would mean like volcanic ashes that causing disruptions to airline industries. And man-made would be, through negligence, power failure. So all the disruptions that cause businesses to come to a standstill, affecting US firms between 1999 and 2016. And what we did was that we actually tested how the stock market reactions and firm performance correlated with the structure and composition of the board. And some of the attributes that we have taken as independent variables, as variables were independence, size, busyness of the director, CEO duality, expertise, and gender diversity. So we tested each in turn. We look at the short-term effect of these attributes on firm performance and market reaction. And we also look at the long-run effect by running an OLS regression. So our main aim of this whole research was actually to see how fast and how quickly a firm recovers after a disruptive event, so what we term resilience. So what we found is that for short-term effects, there were 3 board attributes that stood out. Board independence actually negatively was significant, while busyness and size were positively significant. That's interesting, right? And CEO duality, board tenure, board diversity were insignificant. And the other finding that we found was directors with the relevant industry expertise did not mitigate the decline in share price during the disruptive events. So whether you had more directors in the same industry were not important when it comes to disruption. In fact, one model we tested showed that directors with more industry experience actually negatively affected the CARS. So for long-term effect, we found no significant effect over the 12 months following the disruptive event. But for even a longer period, for 36 months following the disruptive event, we found a negative and significant effect of board independence, as well as busyness. So it was interesting that busyness as an attribute was good for short term, but not good for long term. So of course, we try to rationalize what's happening. We look at literature and we found that board directors can be broadly categorized as either advisory or monitoring. And these 2 roles generally exist side by side, but they do compete for directors' time. And if you think carefully, they can be inversely related to each other. For instance, for independent directors, although they are better monitors, an increase in monitoring effect will result in management providing less information, which in turn leads to a decrease in board advisory activity. And board advisory activity is actually crucial, especially during disruption. So conversely, even though we say that directors' busyness is not good from a corporate governance point of view, and tests have shown that they generally decrease firm value because it hampers effective monitoring. But we also know that busy directors, they are very sought after because of their talents. There are findings that shows that busy directors are usually talented people, okay, good or not good for that sense. But so we realize that busy directors generally perform better in situations when the advisory role of the board is critical. And in our paper, we will also explain that busy directors, because both of them, they have reputation at stake. So when a company is actually facing disruption, they may devote their time more to rescue companies in times of disruption. So these features are particularly relevant when the cost of acquiring information is high and there are greater advisory needs, which is the case, of course, in a disruptive event situation. And all these results came in significant. For the long-term effect, we did find that independent director was not good even after 3 years for a company which has undergone a disruption, which is interesting. So this is something that we may want to continue to see how independence actually affect a firm in recovery mode. Okay, that's one thing. The other thing that we have found is that busy directors, although they may be good for the firm during disruption, it is not good for the firm in the long run. I think that coincides, of course, with a lot of literature in this aspect, that busy directors have too little time to devote to the company when the company is actually doing well, right? So what does our paper show? our paper actually implies that maybe in times of crisis, advice-oriented boards fare better than monitoring-oriented boards. And more specifically, information flows less easily within independent boards. So again, conversely, busy directors and large boards are actually more effective in complex situations, such as during a crisis. So that's something contrary to the normal corporate governance literature. So, but of course, there are things for future research, even our paper. And in view of the COVID-19, I think we can do further and look at some other things during this. So our study, what happened was that our study actually looked at disruptive events affecting a single firm or some specific industries. As I've mentioned, volcanic ash affecting aviation industry, but not an event like COVID-19, which actually affects the world and the crown around all the industries. So this pandemic actually provides a natural lab for us to test our hypothesis on a bigger scale. So that's something that we have been discussing and we are thinking of doing. And the other thing that in our study, we did not find that boards with industry-related expertise contribute positively to firm value during a crisis. So we were also thinking that maybe future research, we can look at what are some of the specific skill sets that a board should have and should be better equipped to deal with all these disruptions that's happening around us. So this is just a very basic overview of our paper. As I've mentioned, all the steps and all the finance-related parts of this paper, the methodology and the detailed findings, you can see in our ECGI working paper series. Otherwise, you can always write email to me. Thank you. That's all for my presentation, and I will hand my time to my colleague, Professor Hans Tjio. Hans, please.
Thanks, Lulu. I'm just going to put my slides up. And thanks to Elaine and the ECGI for letting me be part of this. We've been locked in Singapore for about a week and a half now. And I use that phrase instead of lockdown because it's, there's a reason for it, because I think it's 2 years since Professor Lynn Stout passed away, and she and Professor Blair coined that phrase. And there is something to be said for being locked in, because this conference and this webinar is a result of it. And there might be something to be said for therefore being less efficient in our use of capital, and perhaps keep some capital locked in to build resilience in the system. We all know the narrative has been coming out in the popular press for some time now, but the amount of money that's been spent in America on repurchase or buybacks. There's still some, in fact, have been more buybacks, right? And that's one point of view. The other argument, of course, are from people who believe in corporate purposes or more in corporate purposes, who think that even industrial companies are now becoming investment type companies, which trade primarily in their own securities, right? The added risk there is that the directors are making decisions to repurchase the shares for the company. And so there's some kind of self-dealing going on. And they may even be incentivized to buy shares or repurchase shares at a high price. Unlike Lulu, we've only just started looking at the numbers in Singapore, but it's about the right time to do it because we've had our share buyback provisions now for about 20 years. Prior to that, you couldn't do it at all. About 10 years ago, I think the listed companies in Singapore started actively buying back their shares, but this has been most significant in the last 3 years. And it culminated in March 2020 when we saw fairly large, in fact, very large amounts of buybacks, probably the highest in 5 years. The banks in particular did a lot of buybacks all the way from the end of February until 23rd March, which was the low. As with most countries now in the world, the Monetary Authority of Singapore has now stopped buybacks as part of the bargaining and the trade-off for relaxing capital requirements for the banks. But as with many countries as well, we haven't stopped dividend payments by these banks, which again suggests that maybe buybacks and dividends are not exactly the same, despite some people arguing that they are. But again, those people who are arguing that they are, it's not clear that that's what they would be arguing for now. In China, perhaps those of you in Beijing would be able to correct me if I'm wrong. It wasn't really allowed until 2018. I mean, there was very restricted amounts of buybacks, but largely because of fear that you could thwart a takeover with the share buybacks, they didn't really allow it. But in 2018, the regulators allowed it, possibly because they were worried about low share prices of newly listed companies. I think in the early part of 2018, there was quite a bit of market turmoil. And so in a sense, the share buyback provisions were brought in as a form of circuit breaker, right? So within 3 years of a listing, the rules are now that if for 20 days the listed share, the price of the listed share exists for 20 days below the net asset value, or if there's a 30% share drop within 20 days, the law actually says that the listed company can buy back their shares under a stock price stabilization plan. But it appears as if the exchange rules mandate this. So the legislation allows it, but the exchange rules mandate it. And I think most of us don't have any problems with this if it's really about stabilization. But as we've seen in other areas, stabilization moves to something else. And so what should have been a circuit breaker, and we're all part in circuit breakers now, becomes a way of life. And then it becomes too late to stop it, and then there's too much of it. And we've seen that in China with the bringing in of the Trust Act in 2001, ending up in the creation of trust companies and their wealth management products, of which some people say has created all the problems in the financial sectors because they are twice the size of even the market capitalization of the Shanghai and Shenzhen markets. But it's about stabilization that's really the problem, because the numbers that we are seeing in Singapore now from the preliminary research we've done is that there isn't that much conflicts of interest. There's some of it in these buybacks. There really isn't insider trading, or if there is, we can't really prove it. But what we're seeing companies do, listed companies do, is to stabilize or ostensibly stabilize their shares. But stabilization has always been seen prima facie as manipulative. And so, as with many countries, we've got exemptions in IPOs for the lead managers to stabilize their shares. We know that the FSA has said that stabilization is market abuse, but it's okay if it promotes the orderly operations of the market, right? But these are really done by the lead managers in the IPO. The share buybacks by companies, on the other hand, that creates even more problems. And up to 1982, we all know that it was considered market manipulation in the US. It's been relaxed since then, and we've seen a lot of it. But we have a recent Singapore decision that says that even a buyback by a company to counter a short selling attack was possibly manipulative. And this was a case where a financier and a listed company got together to try and prevent what they thought was an attack through short sellers on the listed company. And at the High Court, it was found to be illegal and void. The Court of Appeal confirmed this, but instead of using securities laws to say that it was prohibited, they went back to basic company law. And our Companies Act is still quite traditional in that sense, that there are strict requirements for a buyback, which requires various shareholder resolutions. And as the share buyback gets to be more coercive or more selective, the shareholder resolutions gets to be more stringent, right? You end up with a special resolution. But the most important thing that you have to obtain is the ex-ante director solvency statement. And in this case, the listed company didn't get that. And so everything was avoided by the Court of Appeal as well. The important thing for us is that the Chief Justice said that these share repurchase prohibitions, restrictions are rules not just to maintain capital, but also to prevent depletion of corporate assets. So it's both regulating the left and the right side of the balance sheet at the same time. And certainly there's some of that, because with the buybacks until 15 years ago, recall I said we introduced it 20 years ago, but 15 years ago we allowed it to come out of capital as well. But prior to that, it was really only out of distributable profits. And that's why I think the story is that they're still not really the same as dividend, because they can come out of capital today. But what the Chief Justice said was that these rules are there to protect creditors, but also shareholder fairness, right? And it's the same with the prohibition against financial assistance for the acquisition of shares, which again, the Chief Justice in a separate case had said that has this dual role of maintaining the left side and the right side of the balance sheet. But we all know that everybody has been liberalizing their laws with respect to capital maintenance. The UK which we still follow, and that's when we follow Australia as well. They've permitted it since the 80s. And that's obviously talk with Brexit to move down the American path even more and to leave it to fraudulent conveyance rules, which ultimately means that there has to be some kind of insolvency from asset depletion coming through it, right? Because that's how you defraud your creditors. I'm not sure we're going down that path. The danger with that path is that solvency goes both ways, right? After the global financial crisis, we've seen many countries enact provisions, whether for banks or generally, to make it harder for solvency or for insolvency to be proven. But at the same time, it's hard for directors to issue a solvency statement. There's always this worry that there's liability attached to it. But to switch it to the US way, which is to leave it to solvency rules, it's also dangerous because, as with many things in this world, the burden of proof is crucial. And we see that with things like causation and third-party notice. Very often, if you bear the burden of proving either solvency or insolvency, it's going to be very difficult to do. But these are just the practical problems, I guess, with buybacks. There's still conceptual problems, and people have written about this over the years, that if you see the share as largely contractual, then when a company buys back those shares, those rights should be cancelled, right? But at the same time, we also know shares have a property element, and therefore we allow treasury shares to exist. But as things stand, even in the US, you can't really keep your treasury shares on the asset side of your balance sheet. They have to be sort of taken off from the liability side of the balance sheet. The outlier here is the EU second directive, which since inception has allowed treasury shares to be both on the asset side and on the liability side of the balance sheet. The other problem with buybacks is that it's easy to facilitate it. So in '82, I guess the US removed the market manipulation prohibition, possibly because the Dow hadn't gone anywhere from 66 to 82. Some academics have written that we introduced our buyback provisions in 98 to 2000 because of the Asian financial crisis. Right? But as I said, if this works as a circuit breaker of some sort in an emergent situation, that's fine. But it becomes a way of life, right? And it becomes very difficult to rein in. It's true that it's difficult to tell what's a market top. But one question that I've had for some economists, and I've not really been able to get an answer, is whether your normal demand curve for shares should include the firm as a buyer of those shares as well. Whether your industry demand curves actually have outsiders buying your goods rather than the firm producing those goods. And there's some of this here because the Singapore Exchange has said that the firm should buy back their shares as cheaply as possible. And I think this ties in with some of the Australian and Singapore cases that talk about supply and demand curves, and that manipulation is where you're actually not adhering to normal forces of supply and demand, and that you as a buyer should be looking to buy as cheaply as possible, as opposed to as high as possible. In the end, however, it's still difficult to make arguments for regulation. It's a reality, except that this COVID has shown us that a buffer is needed. And this buffer, if it's not provided by individuals because we don't save, companies don't save, I guess governments have to do it. The only thing that goes against this perhaps is that buffer can be maintained for buybacks as well. And so there's some evidence out of the SEC that buybacks may have worked to stabilize the market in 1987. But then this goes back to the other point, which is that it should really be used exceptionally. So just as we prohibit short selling in an emergency, perhaps we should only allow buybacks in an emergency. Thank you. And I think Weina is next.
Hello, everyone. And thank you for giving me this opportunity from ECGI, and thank you, Lele, for inviting me to be part of this sharing. So today I'm going to talk about is the glass half full or half empty, corporate social responsibilities in crisis time. So in the past, and we know that corporate social responsibility usually get pushed back because of classic finance theory suggests that the primary purpose of company is to maximize the shareholders' value. But the counter argument was put forth in 1984 by Freeman, saying that the corporates should also take some social consciousness in making their corporate decisions because they have wider stakeholders to be considered. And in most recent few decades, there's continuous increase of academic interest in the link between the corporate social responsibility and firm value. And the researcher has been showing more and more evidence that the CSR can actually go beyond a simple marketing business strategy, but it can actually contribute to the bottom line. And given these findings, as well as two other trends, there's more increase of the research interest in this field. So the other two push actually comes from the government regulations and new policies require the corporations to take the sustainability into their decision-making and the reporting. And from the customer and the investors' perspective, there's also increased demand for corporate to exercise their social responsibility. So the next slide just gives us a perspective about what is the development over last 7 decades, starting from 1950. The red line actually shows that the number of articles from Google search engine that climb up steadily over the years, especially in the last 2 decades. Okay, and by end of last year, you can see that the total amount of research article that touch upon corporate social performance, which means people are studying between the CSR and firm value more and more frequently. And this number actually add up to almost the 1.8 million articles. So this shows that the steady increase of the research interest in this field. So what I'm going to talk about today is to revisit this concept of social capital. So what is social capital? This is basically defined as a set of features of social organizations such as trust, norms, and networks that can improve the efficiency of society by facilitating coordinated actions. So what is the traditional measure for the social capital is usually done at the country level or specific geographical locations. And more importantly, it usually has a fixed scale because people have to evaluate relatively to another region or another countries. So what we see that in the midst of this pandemic crisis, there are a lot of new ideas that we can think about the social capital. So social capital has not been clearly defined within a for-profit firm, but people have used other measures such as morality, loyalty, employee retention ratio, and even their happiness to capture this part of description of social capital, but it's not directly using the definition itself. Social capital has also been seen across the for-profit firms and its external stakeholders. And usually we use the phrases or definition of network and trust to describe that aspect. And on the societal level, of course, the social capital can also be going back to the traditional definition. So social capital is also not a static concept, because if we talk about a financial capital in the finance context, we know that it can continue to grow, right? It doesn't have to be fit into a fixed scale. So that means that the company can actually continue to accumulate the social capital through their consistent action and unambiguous signals to the public. So now linking the CSR with the social capital in the midst of the crisis is that CSR at the firm level can actually help the firm to create social capital within the firm. So who are the stakeholders within the firm? We know their employees, managers, and even their family members. So by doing the CSR, right, it can actually help the employees to boost their morality and loyalty. And by encouraging the employees to donate and to participate in the voluntary activities in the midst of the crisis, it can also help to promote their altruism motivation as a person. On the second higher level, the CS can also create the social capital with the public and the government, because the stakeholders, including customers, suppliers, and various government agencies. So the corporate donation definitely can promote the corporate image and brand name and sense of pride among the employees. And corporate actions can also get discounts and efficiency when they are donating in kinds. Because a lot of times where individuals, when you try to buy, for example, the mask, right, you have to pay the full price. But if the corporate donation, and they can actually get a cheaper price from, the collaborative efforts of donation. And it can also boost the supply chain morality, because they know that they're contributing to part of the CSR of the company and it's helping the greater goods in the society. And the government can also use the donated cash, goods, and manpower without incurring further budget expense. And again, this will help the firm to accumulate social capital in terms of the trust and network relationship with the government. And CSR, of course, can also help to create, additional social capital at the societal level, because you are promoting responsible citizenship, trust, confidence, and even innovativeness and clear business incentives. So let me give you some clear examples about what the corporates are doing in the midst of the pandemic, and I will describe mostly from the Singapore context. So we have seen that many firms actually be keeping the price of their goods unchanged, or even lower the price in the midst of the pandemic, even though that they see that the demand for their goods continue to rise up. So, for example, NTUC Income provided the grocery for all the general public. So this, in the essence, basically will help the employees that are working for NTUC to increase their loyalty and morality. And then for the customers, suppliers, of course, they will recognize the brand name and they know that this is a trustworthy suppliers. And the societal social capital can also be enhanced because everybody is calm to know that the grocery shops are not going to take advantage of the lockdown and so on. So donations in kind and cash would also encourage every employee to participate, because giving as a group and a community is far more powerful and impactful than giving as an individual. So for example, recently Temasek has been distributing 500 milligrams of the sanitizer to every citizen in Singapore, and such a morality boost is really providing the culture of giving at the societal level, and of course it boosts the Temasek's reputation as a corporate, and the employees who are involved also have a sense of pride and community. And we also see a lot of volunteering activities that have been happening on the ground. So some of the companies face the reduced demand, so they actually allow their employees to participate in any of the volunteer works, such as contact tracing, such as providing the free shuffle, for needed people, and we see many good examples, and this also help the employees to develop their, altruism feelings, and in some cases, the employers actually even encourage the existing freed up manpower to train for the new skills. For example, SRA, Singapore Airlines, most of the people know about this brand name. They actually let their freed stewardess to take up as a facilitator, the health worker, because they are in the service line. So after a couple of weeks of training, they are actually were dispensed to different healthcare centers. They are not caring for the COVID-19 patients, of course, but because of the surging demand for the medical staff for carrying those patients, then there are a lot of people who are already in the existing healthcare sectors are being neglected. So these stewardess actually provided their services because they get upgraded in their skills so that they can actually fill in the gaps where it is needed. So when they are doing this and people observe and watch them on the TV and seeing that they have been participating in all these community works, it also increased the publicity of the company, and the volunteering culture in the societal level were also strongly encouraged. And we are more than happy to see that a lot of innovations that are also happening in the CSR, for example, because of the lockdown. So the office space, it has been actually freed up to host some of the people who cannot go back home. For example, Malaysia has a lockdown, and a lot of church spaces has been used for these Malaysian people to actually stay for the time being of the lockdown. And there's also usage of fixed assets such as transportation, such as the fixed assets that can be also dispensed. And we also see that some of the big corporations can actually adjust their production technology to produce test kits, ventilators, and a mask. And one of the leading one is Volkswagen. They actually transform their production line for the vehicles into the production for the test kits of the COVID-19. So this actually encourages the whole society to see the innovation that can be taken up by the corporates. And of course, this also facilitates the innovativeness within the corporate itself, as well as with the suppliers. So now I'm coming to my conclusion. The past crisis in the literature usually focus on the financial crisis. And even that, we have seen very robust evidence that the firms that are doing well in CSR will continue to do well in longer time horizon. So now we are facing an unprecedented challenges in terms of the demand, declined demand and lack of infrastructure and technology for firms to continue the operation. But this can also serve as a great opportunities for firms to rise up in their CSR efforts and activities, and they also encourage the firms to innovate. And these firms should be rewarded for having a clear and deliberate plan, or even taking concrete actions in generating social capital internally and externally. And from the public and the government perspective, we should continue to encourage more firms to step up in this, because we can give them the public appraisal and endorsement, and the government can even give them the promised future business contracts. So this leads us to the final saying that again probably will be very relevant in the midst of the crisis, is to say a friend in need is a friend indeed. And it takes years to build this kind of social capital, and this is a golden opportunity. So we really want to see more and more people would like to participate, or the firms would also rise up. Thank you. That's all.
Thank you very much, Weina. Sorry that we had to rush the whole session, because I think our main purpose was to showcase as many as possible the work that's being done by NUS at the moment. That's why we sort of put 5 papers in this 1 hour. So what I've done is I've actually I'm going to put up our emails, so that for those who are interested, you can actually email us, and we will share with you our paper and also questions that you may have. Just quickly share with you email. But when I'm sharing, I think maybe Dan can just answer the question that's being put to him. I think he has a question.
Yes, yeah. So that's an excellent question that has been posted. I guess my quick response to that is, I think you raise a valid point that in terms of controlled firms and civil law influence, you have some similarities, some strong similarities between the EU and Asia, but I think there are some important differences. The first difference is that within Asia, we have nothing equivalent to the EU. So there hasn't been the opportunity for directives in terms of conformity. And sort of common corporate lawmaking. The second, I think, very important point is you don't see sort of the grafting over to the same extent of US law and civil law jurisdictions. An interesting, there's many examples, but an interesting recent one is how Taiwan recently got rid of its multi or double board, 2-tier board, and has put in a 1-tier board system. And Korea's done that. So I think you have a much greater influence, and this could be because of the occupation period in Japan, and then Japan's influence within East Asia. But for a variety of reasons, and the Asian financial crisis, you have this heavy grafting of US law. So I think you raise a valid point, but I think Asia stands out in that regard. Also, SOEs, which after COVID, I think this idea of states being shareholders. And Asia has really, I think, led the way in this respect, not just in China, Singapore, but other jurisdictions. So that's my short answer, but thank you for an excellent question.
Thank you, Dan. So because of time, I think we have controlled the time very well. We are going to pass our time over to the PKU scholars, and please stay with us. Li Jing or Guo Li, are you all here?
Yes. Hi.
Yes.
Hi,
so
Lulu.
We'll hand the time to you now. Thank you so much. Thank you.
Thank you. Thank you, Lulu, for the wonderful moderation of the presenters from NUS. I have to apologize. I was dropped from the internet connection a few times during this 1 hour. So I didn't catch the full brilliant ideas of all the presenters. Fortunately, I think we're going to have a video recording, and I will try to catch up on those. I also have to apologize in advance that internet connection seems to not be very stable on my end. So in the unlikely event that I was dropped, I hope that Elaine could kindly pick up. And Elaine has also very kindly offered to share the PPT slides that I have put up. So we at the PKU, we're gonna have 3 presenters. That will be myself, Professor Liyan Wang, and then Professor Li Guo. And this whole hour session will be co-moderated by Professor Guo, who is a professor from the law school, and I myself, who is a business school professor. We plan to split the 1 hour time into 3 roughly 15-minute presentation slots with about 15 minutes left at the end, or whatever amount of time we have at the end to take questions from the audience, if that would be agreeable with you. Without further ado, I would hope that Elaine, you could kindly start sharing my PPT now. Thank you so much, Elaine. So my talk will be a kind of an overview of important issues for corporate governance after COVID-19 in China. Can you turn to the next page, please? I haven't seen the screen turned, but I will start talking. Since I'm a scholar of corporate finance and corporate governance, I think my understanding of corporate governance is it's the study of ways to coordinate the divergent interests of various stakeholders. I will mostly try to take the vantage point of a private sector business and analyze its various stakeholders and their divergent interests and how those are affected by the current crisis, the COVID-19 situation. So the stakeholders that I would focus on would mainly include the consumers, the employees, the supply chain, which means both the upstream and the downstream counterparties, and the financial investors, more specifically the shareholders and debt investors such as the bank, the government, domestic customers. So I'm going to start talking about customers in China. They were greatly affected. They were very concerned about the personal safety issues, understandably. For them, the most important thing is to stay alive. Initially, they didn't know what to do. And following the lockdown policy, they stayed at home and they cut down on almost all social activities. That also means that they laid low in this tough environment and started to cut down on all consumptions, particularly the discretionary consumptions. But at the same time, there's an increase in various antivirus medicines, and also there's an increase in certain online consumptions, such as online entertainment and education. This, for example, gave a boost to all sorts of companies related to online service providing, such as Zooms, or Ding by Alibaba, even many online gaming companies. But overall, we're facing a much more cautious consumption behavior pattern in China. And this is further fueled by the disruption of employment patterns, because a lot of consumers in China are naturally also employees in businesses themselves. And those businesses are negatively affected by the crisis. So there's a fear of a lack of a demand pulling to jumpstart the economy even after the crisis. I think this fear has already started to trigger various government responses to try to stimulate the consumption and protect the employment. We will have more on that later. In China, at the beginning, analysts have very divergent opinions on how long the dampening effect of a weak consumption pattern would last. At the beginning, there was a hope that second quarter consumption numbers would see a rapid and dramatic rebound. That doesn't seem to materialize so far. I think a more pessimistic view seems to be prevailing now, that we haven't seen the bottom of the economic slowdown, particularly if the crisis in other countries do not start to turn around. But then if everybody is so pessimistic and they all start to cut down on consumption, that's going to trigger another vicious cycle. So I think the takeaway here for consumers consumers in China has the main goal at this point of surviving, both physically and also financially. So they cut down on all consumptions as much as they could. And they also changed consumption patterns to more online. Well, this is going to have a profound impact on businesses. If the demand is going to dry up, that's going to adversely affect everybody and everything. Next page, please. And you're already on the next page, Elaine. So the next page is about employees. So let's turn to the employees. Nowadays in China, migrant workers constitute a very large and increasing proportion of the labor force, particularly for the economically more prosperous coastal areas. But most cross-region migrations are curtailed and affected by the lockdown policies now. So for a while, firms don't have enough people to staff the production lines. As we said before, more recent weeks, we've seen that with the crisis situation start to wind down a little bit, there has been a surge of efforts, particularly by local governments, to try to facilitate the transportation of migrant workers back to their jobs. So I think at the beginning, we saw a so-called supply-side labor force shortage that was, caused a huge amount of involuntary shutdown of production facilities in China. But more recently, things start to turn around. And also, as the virus situation starts to stabilize, I think the top priorities in China nowadays is for the employees to be back to the jobs at all costs. Because everybody was handing on their the savings for a lot of workers are not very high to begin with, and they were depleted to a large extent. So they need to be back to jobs to generate enough of a stimulus for the economy to quickly go back to normal. Next page, please. So next, we're going to talk about the supply chain. As China has already entered a rather sophisticated stage of manufacturing and division of labor, a large number of Chinese manufacturing firms now have upstreams and downstream partners that they depend on. So a stop in one link would cause the disruption of the whole supply chain. Perhaps more importantly, a large number of Chinese firms rely heavily on overseas suppliers and distribution chain. And also because China is at a different stage, a different phase of COVID-19 compared with many other affected countries and regions. This also has rippling effect on the Chinese firms' supply chain. Early days, Chinese firms just cannot produce because they lack raw materials, intermediary goods, and stuff like that. But more recently, they cannot sell. Now they have people back to the production line. They have products ready, but the whole retail distribution chain globally is now disrupted. And there's an increasing concern also at the bottom of this page, the next bullet point. There's an increasing concern that there's going to be a disruption of the global supply chain after the crisis. The upshot here, I think this COVID-19 crisis happened at the worst time amid the rapid adjustment of the global supply chain, and it will probably exacerbate the problem of the readjustment of the global supply chain, even the so-called decoupling of the global economy. So next page, we're going to talk about investors. These are financial investors, including both the shareholders and also debt investors, such as the banks. Well, they provide capitals for the private sector businesses. And this market, the capital market in China, has already undergone a lot of changes recently. I understand my colleague, Professor Guo Li from the law school will elaborate more on those. For now, I will just point out that China started crack down on the so-called runaway financial innovations on the capital markets a few years ago, long before the crisis hit. The aim is to reduce the so-called systematic risk of the capital market, because there's a lot of so-called financial innovations that are aimed to circumvent restrictions on investments into the real estate sector in China at the expense of the manufacturing sector. And the regulator think that's not healthy. So they started cleaning up the mess a while ago. So even prior to COVID-19, the valuation in the Chinese capital market has been pretty low, I would say. But also because of that, the overall slacks of the market has also been cut down quite a bit. So after the crisis, the stock market was hit and it reacted negatively, but much less so compared to that in the US and European markets on average. Still, if we turn to the next page to continue this discussion a little bit, the crisis exposed a lot of vulnerabilities of the Chinese capital market. Elaine, can you please turn to the next page? So the vulnerability of the Chinese market is still pretty high, and then therefore the valuation is still pretty low at this point. I think investors in China are still very concerned that there's a shortage in the Chinese saying, there's a shortage of high quality investment opportunities in China. Can you turn to the next page, Elaine, please? We'll continue our discussion about investors, which has 2 pages. So I will just start talking. Investors are particularly critical of disclosure and transparency issues in China, particularly, please go to the previous one, sorry. The page on investors continued. We're probably 2 pages ahead. Can you turn back? Thank you. So as I said, important concerns about disclosure and transparency issues in Chinese companies. This is particularly in light of the recent scandal that some people might know of some overseas Chinese companies, such as a company called Liyan, which is a coffee maker that has a very ambitious aim to overtake Starbucks in China, but only to self-report that they had manipulated accounting numbers recently. And this caused a huge backlash among global investors about the accounting practice and accounting quality of Chinese overseas listed companies. And also a lot of self-inspection about domestic companies that are listed on the Asia capital market. I know Professor Wang, who's going to be next, will have more to say on these issues, so I will not elaborate. And also banks in China are pretty hard hit because many of their borrowers, the firms, are struggling. They cannot repay the loans, let alone interests. Government actually wants the banks to step in and share the burden of the economic difficulty. And particularly because banks in the recent years have done pretty well and have been very profitable. So there are a lot of pressure for banks to give, for example, grace periods for repaying the loans, or even to forgive the interest or even principal payments, et cetera, et cetera. But from the vantage point of corporate governance, I think this presents a huge conflict of interest. So banks will probably do the calculation. Do I lend to a failing business? If I do so, well, I might lose money. If I don't, everybody is going to hate me for not lending a hand to a failing business and cause disruptions. I think this is a conflict of the so-called social interest and private interest. So I guess, the question here is, should social responsibility prevail over profit maximization principles? So in corporate governance, we talk about CSR, corporate social responsibilities, a lot. It has been an important issue for Chinese companies as well. What about in a crisis like this? And what about beyond China? In a country like the US, would Goldman Sachs or JP Morgan Chase be asked to cut down on interest or even principal payments? Would HSBC or Deutsche Bank in Europe do that? So I think here the takeaway is that this crisis exposed a lot of existing deep conflicts of interest among various stakeholders, particularly the financial investors and other stakeholders. Let's go to the next page. I know I'm already over time. I apologize for the bad connections, and then I will try to speed up. So next page, we're going to talk about the government. Elaine, if you could turn to the next page. I would say that overall, I think the government has been very proactive in dealing with the crisis. And also in China, the government is very resourceful. Still, after the fact, I think there's a lot of inspections. There's still a lot of rooms for improvements, to say the least. But overall, judging from the current outcomes so far, most people in China, and I would say even Chinese students overseas studying, they seem to be reasonably happy with the way that the government handled the situation overall. Well, that probably can be said also about governments around the world. After the fact, they could have responded sooner, faster, more forcefully, but overall, their citizens are supportive. I think in China, overall, the emphasis is more on containing the viruses and saving lives than on saving the economic growth. But this can be controversial, I would say, both within China and also outside of China. I think there has been a big controversy, particularly overseas, on how forcefully should the lockdown policy be conducted. Initially, there was a lot of criticism. Probably China did it too soon, too forcefully. But after a few months, seems to start to turn around a little bit. I would say that even among the academics in China, there is still this debate, but most of the grassroots people, they seem to embrace the current policy that people's life matters more. They take far more priorities compared to everything else. But that, again, I realize that can be a controversial issue among different cultures. Let's turn to the next page. With the very limited time left, I want to emphasize the last, but certainly not the least, the entrepreneur. They are the center of economic prosperities in any society. They are also hit the hardest in China. Elaine, can we turn to the next page, please? Can we turn? Yes, good, thank you. So they have a very tough environment in China. Many businesses are just barely hanging on. The government certainly do not want to see these businesses shut down and workers let go. So they wanted to do everything in their capacity to persuade the companies to stay open. But there's not enough orders to fill. So workers are back to work, but there's just not enough demand. But they have to stay open. And a lot of business people, entrepreneurs, they are very worried. They don't know what they should do. They would, sometimes my friends would say, oh, if I'm a business person, it is my responsibility to keep my workers employed. Why can't I just declare bankruptcy and liquidate and send the workers home? But in China, it's not easy. I mean, there's certainly a lot of encouragements for the firms to stay open. The government also imposed very strict rules to let go of employees, the so-called N+1. You have to pay a lot of compensations to let go of workers. So some people actually complained that the Chinese government relief money, they came in the form of loans to the entrepreneurs rather than a gift. So the entrepreneurs would say, well, we have to repay the loans later on if we become profitable again. Some think, well, that's unfair because we are actually using the money to save our employees also. And then now we are asked to share a bigger burden, maybe even all the burden. And extreme situations, there are some entrepreneurs refuse to take the relief loans from the government. They say, well, I'm going to just shut down my business. Again, here, I think the question or the tension is really on where does the boundary lie for the social responsibility for a business to take care of their employees versus to stay profitable and to maximize their profit. Given that I'm pretty much running out of time, I want to spend the last couple minutes to go to the next slides, which is the last one. I think there are important lessons that we should learn in terms of corporate governance issues post COVID-19 for China. The first, I think, is on how to better handle early warning signs. Can you turn to the next page, Elaine, please? There's a direct reporting system in China that was established after SARS, but this time it wasn't utilized until a very senior scientist, Mr. Zhong Nanshan, openly remarked on how bad the situation is. So what went wrong? Why didn't the system that's already in place didn't function? I think there's a lot more digging to be done after the crisis. There should be more. I think we have to have accountability there. Second, should we trade off human safety?
Lee's connection has just dropped there, so I think we might just pause it and we might move on since as this presentation was over or finishing. Oh, I think he's rejoined. I'll just give him a moment to move on.
My connection was lost. I apologize. Now I think I'm back. Thank you. So my second point is, should we trade off, human safety and human lives with economic growth? I guess most people would probably say, well, this is a no-brainer. The former is far more important. But some argue that, well, without the latter, the former cannot be sustained. So at this point for China, reopening the businesses while the virus still is not fully contained, is that a good or bad idea? Of course, divergent interest group would have probably different views and different priorities on these issues. For example, retirees versus working people, low income versus high income people. Those can work from home online versus those who have to work in a store offline. They probably would have different ideas. They probably all think that the government should pay more attention to their sufferings. For example, they're starving, they're shivering from the fear of getting the virus, they're losing their lifelong savings and investments because the businesses they invest in are shut down, so on and so forth. So how do you handle this balance, this very delicate balance among all different groups? The third, among the mistrust, the finger pointing, and the apparent breakdown of the global supply chain system, should China still embrace globalization? My answer to that is a resounding yes. But I understand there's a controversy here. Many in China think that we should lend a helping hand to others who are still struggling. But some point out that, well, those behavior might not always be welcome. Some actually were concerned that there could be a conspiracy theory behind the motivations for China relief efforts, even for those conducted by individual businesses. For example, Alibaba has done quite a bit of this. And I think the response from overseas was not always positive. But I think most people in China believe that we should continue to embrace globalization even after the crisis. Anyway, China has benefited the most in the past several decades. But some start to question whether, whether China is welcomed. I think, or I should say, I hope that the consensus here is, no matter what, China should keep opening up and keep embracing the world. We in China are much better off than we were about 20 years ago when we joined the WTO. Hopefully, overall, the world is going to become better because China joined. I think there's so many things that we can further improve. And the world should also benefit more from including in China in this effort. But there are backlashes. I think at this point, there's a real concern, there's a real danger that some hawkish elements in the US is going to further fuel the extremist view in China also on this. We have to just work together with the rest of the world to curtail that. So with that, I conclude my part of the presentation and then hand over the podium, the virtual podium, to my colleague, Professor Liyan Wang, also from PKU.
Hello, everyone. Could you hear me?
Yes.
Oh, that's great.
Yes.
Let me start with my, I guess, PowerPoint. Is it all right? Could you see the PPT sliders?
I can see the slides. If you want to press slideshow and show the full screen, otherwise, alternatively, we can see it.
Yeah, that's okay. It's okay.
That's great.
Hello, everyone. Thank you very much for this opportunity to share some feelings with academics and the practitioners all over the world. I do agree what Professor Jing Li just said. I personally focus my presentation in two words. One, corporate governance, and two, the information disclosed. In my short presentation, I focus on two issues. One is the ESG information disclosure in 2020, this year, from Hong Kong to the mainland. This, for the transparency and the information disclosure, accounting or non-accounting, for the listed overseas Chinese firms, not just in Hong Kong, but also in United States, in Great Britain, and some other Europe exchanges. However, focus on the ESG information, I just pay attention in Hong Kong because this year there are something new, different from the earlier years. I scanned some original paper here. It's not in English. Let me speak, try to clearly. From this year, the Hong Kong Stock Exchange, we just call this Hong Kong Exchanger, have some new requests for the companies. In mainland China, in a lot of companies listed in Hong Kong, we call them H-share company. For the new request, the company should do something different from earlier years. Look here, it's a new request. Yeah, here in English. The H-share firms totally till the end of last month, about 300, including 120 dual listing firms. I say dual listing firms means a share listed in mainland China, Hong Kong, Shanghai or Shenzhen as two exchanges in mainland China, and also H-share in Hong Kong. And the others just listed in Hong Kong. However, this 283, roughly 300 H-share firms, they operating mainly in the mainland. Especially the 120 dual listing firms, they should follow both mainland law and the regulations, and also the Hong Kong's law and regulations. For today's issue, I just focus on the ESG information. This year, there are some new requests. So for the 120 dual listing firms, they meet new situation. Based on my personal observation and discussion with the 2 H-share firms, because I'm teaching in Peking University's Guanghua School of Management. My major is accounting, so my discussion focus on the auditors. For auditors, there are 2 of the big 4. One is Ernst Young, another is KPMG Pitmaric. They are the auditors for these 2 H-share firms. I have close relation with them to discuss the new situation, new request from different from last years. I personally think there should be positive outcome to the ESG information disclosure for the H-share firms, especially those dual listing firms. Oh, this new issue. Let me conclusion from the first issue. Why I say there should be positive outcome, because the request, the mandatory request for the H-share firms, including the board member, should pay enough attention to the ESG information and also ESG behavior from the company. And also the CFO and the financial accounting sector, they should disclose expense and some related with the financial reporting. These 2 companies, I have a close relation with 2 companies. I observed this and discussed with not just the CP auditors, but also the board members and senior management. They are now pay greater attention on the new request. However, since the pandemic now, COVID-19 pandemic, so the report preparation and the disclosure right now not so prompt. For example, I cannot leave Beijing now to take part in a board meeting to observe something I very care to the company. However, that's the very important issue now for the companies. So I think there should be, and I believe there will be, positive outcome to the ESG information, the information quality, and the information contents. That's my personal consideration. Let me, beside the ESG information, let me mention another thing is the environmental sensitive company in recent 3 or 4 months also taking their important part in the anti-COVID-19 pandemic. I can give a case. This case also a dual listing company, but not listed in Hong Kong, but the A, B share. That mentioned, that means A share is mainland by renminbi, and B share by US dollar or Hong Kong dollar. We call it a B share. This firm is both A share and the B share. I call it a dual share firm, listed in Shanghai Exchange, cement industry. Very special case because this company is headquartered at Wuhan, and the cement plant nearly all over the South China, more than 10 provinces. And another special point is this company, because B share, this company's first larger stockholders, not Chinese firms, not Chinese local or central government, but a Europe company. The name I think a lot of people know, it's Lafargue Holcim Group, both headquartered in France and Switzerland, and also listed in European Exchanger. I mentioned that means it's not just the Chinese listed firm in mainland China, because nearly half of capital are European capital. So I personally like to say it's a multinational company. Actually, it's an international company. In recent 3 months, the Huaxin firm, it's the cement industry company called Huaxin, HX. The Huaxin firm to dispose the waste from a hospital in several cities in 4 provinces. So the listed company, especially that environmentally sensitive companies, can do a lot than before during or facing the COVID-19 pandemic, or some year later, there are some different pandemic. That's my case for the company doing something in recent 3 months in the anti-COVID-19 pandemic. For the companies take part in the anti-COVID-19 pandemic, how about later? I cannot give conclusion, but I pay attention on their next step, next step. For example, I believe this international company, environmental protection sector, or I call the environmental industry, also new operation in their operating. Possibly, I think the environmental part could be step faster than their traditional operation. That's what I shared with academia and the practitioners of the world. Thank you very much. Should I turn to the chairperson? Thank you very much.
Yes, thank you, Professor Wang. I think next we have Professor Guo Li, who is a co-moderator with me on the PKU session. Please, Professor Guo.
Okay, thanks. Can you guys hear me?
I can hear.
Yes.
Okay, perfect. Let me share my screen. Thank you, guys. I would like to start with thanks to ECGI's, Elaine's, and all the participants. I hope all of you are doing well. So my observations is from the legal perspective. So to background, in addition to the COVID-19 pandemic, the same challenge we are all facing together, in China, there is something new I want to share with you, which is China has a new versions of securities laws very recently. As you can see, Chinese lawmakers passed the revisions late last year, as the new laws became effective a few weeks ago, in the March 1st this year. Given the time constraints, I will focus my presentations in 2. One is about the listing, and the second is about the litigation. Try to put in the implementations of COVID-19 in these 2 points as well. First is about IPOs. For those of you know China, the old systems is the approval systems, which was a kind of merit-based. The new laws introduced the new system, disclose-based registration system. It's called 注册制 on principle. And this one's currently is only used in a very slight part of Chinese securities market, which is we call the star market in Shanghai Stock Exchange, 科创板. I will have further explanation very soon. So the directions, also the transitions, will from the merit-based towards disclose-based. It will take some time. So for the time being, the only board use the registration system is the star market in Shanghai only. The next ones is supposed to be the Kinex board in Shenzhen Stock Exchange. And the rest board in 2 stock exchange will follow the suit. So the government will decide when they will be shifted, when they will change to the new system. For the star market, that stands for Science and Technology Innovation Board. If you see at the top, they pick up 1 letter from each word to make a very nice name for the market. And this market was launched by President Xi himself, focus on the high-tech and strategic important sector. To be accurate, 6 sectors were identified, including 5Gs, new energies, and biochemistries, so on and so forth. Up to now, there are about 100 companies listed in the star market in Shanghai. There are couples of new characteristics or features of the star market. I already mentioned it's the first market in China to use the registration system. Second, there will be division of labor between stock exchange and the regulator itself. In China, the major regulator is the CSRC, China Securities Regulatory Commission. So basically, the stock exchange will take care of the IPO screenings in the first stage, and if they approve it, they will pass it to the CSRCs for formal registration. So far, the CSRCs agree with the stock exchange in most cases. Third, the new listed company in the star market are more accommodating. For example, now, even for the company without a profit history background, they could be allowed, could be permitted for the consideration of IPO. Similarly, for companies with different shareholding structure, by that I mean they have different classes of shares in terms of voting power. Before the star market, it was no for mainland China to list those companies, but now it's possible for the star market for doing so. At the other hand, for the investors, the requirement are higher from the 2 dimensions. One is they must have 500,000 yuan in their stock account, and second, they should have 2 years trading experience before they can join the game. And because the stock price for this star market it's more vulnerable. If you can see, so far as the average PE ratios is quite high, substantially higher than the other part of the stock exchange. So this graph, so for the purpose of corporate governance, we know that the principle is one share, one vote, but depend on the combinations of cash flow rights and control rights, there could be certain deviation, like preferred shares, like control enhancement mechanism, CEM. For companies with shares of different classes, for voting powers, it's one kind of CEM. As I said earlier, those companies with such structures, now it's possible to be considered for the stock market listing. So that might be a good thing. When we talk about such kind of company, I guess the examples came to our mind. It would be the Tesla's. Professor Jing Li, he mentioned the Luckin Coffees. They have most of the business in mainland China, but incorporated and listed in US. Recently, there was a contents or disclosure problem associated with this company, and that is page one news, a very hot topic in China. Both companies has the structures of different voting power. So theoretically, those companies could become a candidate for the stock market in Shanghai. So this is some personal experience or anecdote. I happen to be appointed as the first chair of the stock market listed committee. So for each applicant, we have a panel of 5 members to have final reviews of their document, ask questions to decide yes or no from the stock exchange perspective. Nowadays, since the virus issues, we have to do it online to do the connection between Shanghai and Beijing, well, the face masks. And also due to the impacts for the applicants recently, we almost always end certain questions about these issues, like is there influence impact of COVID-19 on your companies? Is that long-term or short-term based ones? Extent of the interruptions or disruptions on the supply chains mentioned by Professor Jing Li earlier. So the applicants, the companies, the issuers, they need to answer that questions and give their decisions or judgment. Similarly, we also ask questions about the disruptions on the governance, compliance, because some of those applicants, they have business across the world. So there is legitimate concerns on that as well. So the companies, they will provide additional information. We will ask those information to be included in their disclosure document. If we feel still uncertain, not enough, we will ask for more commitment from the large shareholders or from the issuer or from the intermediary, the securities firms they hired. The next point is the second one is about the litigations, because the whole system has been shifted towards disclose-based. In case there is a fraudulent disclosure or misstatement, we got to have some things to cope with. So the new laws also bring some new systems and mechanisms in this regard. On the whole, China takes the approach of the civil law countries like the Japan's or Korea. So for the civil litigations in this regard, we use representative civil litigation rather than the US-styled class action. This attitude is largely kept by the new law. Under the new laws, there are three mechanisms where the injured, damaged investors can bring their petition. The first one is the traditional ones. Basically, because this kind of litigation usually involve a large numbers of investors. Before they came to the court, they can take on their own initiative, decide on their own representative. So the type one. The second type is some investor, some plaintiff, they can bring the petition first to the court, and the court will make announcement, and other investor in the similar situations could choose to join by registered with the court. So this is the second type. The third one is brand new. In China, there are two government-sponsored investor protection organizations. And the new law says if they collect the interestings from 50 investors, those two organizations, either of them, they can bring the lawsuit in the court and to be named as a leading plaintiff. The other investors will take an opt-out approach. So basically, they will be included in the group automatically, except some of investors clearly express they want to get off. They want to do the lawsuit on their own, so on and so forth. At the same time, the new laws also enhance the enforcement and punishment, both from the civil litigation perspective and the government sanctions, I would say administrative sanction. This is the last slide. Basically, I put forward certain possible research topic, to do the comparisons between the stock market listed company Wang vis-a-vis the other listed company in China mainland and overseas. The second, to compare the new type of litigation I just described with other litigation. The third, in the morning sessions, our Korea and Japanese colleague, you discuss about force majeure, change of the circumstance, frustration of purpose of contract. The similar dispute or debate are going on in China as well. My personal opinion is they could not simply used as a defense or reasons. It's pretty much factor specific. You need to have more evidence to show if you argue for those cases. Last but not least, as mentioned by two of my colleagues in management school of PKUs, we have quite a lot cross borders listing company. Some of them are in trouble now. So we are going to deal with those issues for the jurisdictions, for the corporations, or maybe competing for the powers for those cases. And also, given the factor of the COVID-19, the home buyers, or the discrimination against the foreign listed companies will become more common. So I'm going to stop here and thank you again and best wishes for all of you. Elaine?
Yep, thank you very much.
Back to you.
Yep, great.
Hi all, I think we are running a bit short of time, so we may not have time to take questions. So for those who have put up your hands, maybe you can just email, send your email to the PKU scholars. Okay, so we are going to have a short break of 30 minutes. Thanks for staying on with us. So do join us back 30 minutes later. You will be taken over by Tel Aviv University. And in the meantime, you can leave the chat room and then rejoin on the same link again. Thank you.